Welcome back to another presentation on a summary of economic projection. Oh, I'm sorry, not a summary of economic projections. This is this is another document from the Federal Reserve called the Federal Reserve Minutes from the last Federal Reserve Board meeting. They usually come out somewhere between 4 to 6 weeks after the last Federal Reserve Board meeting. So in my opinion, there's definitely some lag in the data that we get. However, the reason we look at them is because we look for hints in potentially the following. Number one, weakness in businesses. We want to see that the Federal Reserve is at least starting to have the impression that businesses are starting to feel pain. So that way, businesses stop hiring as much. Now, that it becomes very important because when businesses at least stop hiring that much, they have less job openings. And then the Fed feels like, hey, if there are less job openings, then less people are going to leave their jobs and potentially get paid more somewhere else. Generally, when you leave your job, the wage increase that you've seen in the last year over year, has been twice that of whether or if you stayed. So let me make that clear. If you were making $100,000 and you stayed at your job, you could probably after a year expect to make about $107,500. If you went to a new job, you could potentially expect to make $114,900. So roughly twice as much bonus money as if had you stayed, right? And so the Federal Reserve wants to see these job openings get crimped. And when we start seeing weaknesses at businesses, then we potentially start seeing these job openings close, and then we reduce the potential risk of a wage price spiral. Back in January, back in January, I warned that the most dangerous thing that could happen is any semblance of a wage price spiral. And unfortunately, we're kind of having some feelings that wages are very, very sticky in terms of inflation, and we might actually start running into some level of a wage price spiral, and that would absolutely be devastating. And the Federal Reserve will do everything in their power to stop that, because a wage price spiral is just, as Jerome Powell tells us, completely unacceptable. Like high inflation is one thing. A wage price spiral is like they will full stop do whatever they need to do to destroy the economy to prevent a wage price spiral. The reason they do that is because if you let a wage price spiral persist, you destroy the country's currency, and then you potentially have a complete government collapse. Like that's the mega worst case scenario, right? So the first thing we're going to look at notes on businesses. Then we'll sort of a side note, I think, is going to be some notes on housing. Robert Shiller, the founder of the Case-Shiller Index for housing prices, is under the impression, based on his studies and research over at Yale University, that housing wealth and the power of the wealth effect is most heavily affected by homeowner net worth. That is, when the stock market goes down, people keep spending. When home values go down, people stop spending. This morning in our course member live stream, we actually reviewed Generac. And I'll tell you, Generac was actually one of the greatest financial reports I've seen in a while. Like their financial numbers were actually very, very good. There were some problems, some expenses went up and some declines that we saw in certain places. You wouldn't want to see them, but very, very good otherwise. However, if homeowner net worth goes down and 80% of their customers are residential, you have problems. We do those sorts of analysis almost every day with course members. And so we're going to look at jobs, we're going to look at real estate, and then obviously a terminal rate to potentially bring inflation down. So very, very important. So we'll see what happens. The minutes come out within the next 60 seconds, and we'll be going through them together. We're going to be going through notes from both the Federal Reserve document itself and, of course, notes that we could find from Wall Street. So here we go. Federal officials favored reaching restrictive rates in the near term. Many saw cost of too little outweighing the risk of doing too much. All right. Yep. Minutes. I'm just downloading. Okay. Several saw the need to calibrate Fed tightening to mitigate the risk. Remember last time they all voted unanimously to hike at a 75 basis point hike or pace, and now we're expecting to see potentially another 75, depending on what inflation does tomorrow. Fed officials saw slowing the pace of hiking at some point. Policymakers reaffirmed their strong commitment to returning to inflation to the 2% target. That's actually a potential risk factor, right? Is that they're so adamant about getting back to 2%, with many officials stressing the need to stay the course even as the labor market slows. Consensus was to purposefully move to restrictive stance in the near term, though officials saw it as important to calibrate the pace of tightening. Many officials saw the need to maintain restrictive rates for some time, holding rather than pivoting right away. Policymakers backed continuing to shrink the balance sheet at the current pace, with a couple of officials saying it would be appropriate to start considering mortgage-backed security sales after reduction was well underway. Interesting. That's actually something they have not done yet, is mortgage-backed security sales. So let's go ahead and see what we can see as in terms of the staff review of economic situation here. So information available between the September 20th, 21st meeting suggests that U.S. real GDP was increasing at a moderate pace. I don't think anybody actually believes that. I think most of us think we actually are in a recession. Labor demand remained strong, and the labor market continued to be very tight, right? So these are actually things that we don't want to hear. Not so great. Total non-farm payroll grew. That's fine. We already saw that. Labor force participation rate rose on net, although in the last jobs report, it fell a little bit. Average hourly earnings rose 5.2% over the last 12 months ending in August, while the ECI, which is the employment cost index in the private sector, which includes benefits, rose 5.5% over the last 12 months. Consumer inflation remained elevated. So they're just kind of reviewing some of the numbers here. I'm going to jump forward a little bit. I want to see if we can get any kind of particular note. Here we go. Current conditions. Let's see. In conjunction with the FOMC meeting, participants submitted their projections. This was the last summary of economic projections we got. In their discussions, participants noted recent indicators had pointed to modest growth in spending and production. Job gains had been robust. Inflation remained elevated. I mean, none of these are great. Participants recognized Russia's war against Ukraine was causing tremendous hardship. Participants remained attentive to inflation risk. So nothing new here so far. Participants generally anticipated that the U.S. economy would grow at a below-trend pace this and the coming few years. That's interesting. So the next few years of potential slower growth here. As monetary policy assumed a restrictive stance and global headwinds persisted, participants noted a period of below-trend real GDP growth would help reduce inflationary pressures. Okay, fine. So far, pretty generic here. In their discussion of the household sector, participants noted that consumer spending grew moderately, reflecting strength in the labor market. Strong household sector balance sheet. Several participants noted that spending appeared to have held up relatively well. See, this is actually not good, especially higher income households. These participants also noted that the composition of spending by low to moderate income households who were affected by a greater degree of inflation was changing, with discretionary expenses being cut and purchases shifting to lower cost items. So basically what they're saying here is we're seeing a transition amongst the poorer folks who are getting hit harder by inflation, but we're not actually seeing rich people start cutting back. With regard to the business sector, participants observed growth in investment spending appeared modest. Got it. Let's see here. Okay, come on. This is nonsense. Okay, there we go. Let's see. Participants discussed how they perceived challenging supply chains to be evolving. This is not the word you want to hear. You want to hear that supply chains are getting better, not evolving. Many participants remarked that their business contacts were reporting signs of relief in supply chain bottlenecks, such as declines in shipping costs and delivery times, while some participants saw little improvement in the supply situation. So you really have this tale of almost two cities, even in the business world, where some businesses are seeing improvement, but others aren't. So what you definitely don't have is there's no broad-based deflation yet, right? So we'll write that a little note here. Participants observed that the labor market had remained very tight. Okay, let's see if they give us any more insight about this. Elevated job vacancies and quit rates, low pace of layoffs. A few participants remarked that employers facing particularly acute labor shortages were those associated with professional occupations, service industries, and skilled trade. So if you have a professional designation, you could probably demand higher pay right now, but you would be contributing to wage inflation. But that's not your problem. That's the economy's problem. But some participants noted that a number of developments consistent with the labor market moving towards a better balance, including a lower turnover. However, several participants assessed the scope of further improvement in the labor force participation as likely limited. Fine. Participants anticipated that supply and demand imbalances in the labor market would gradually diminish. This is not exactly what you want to hear, right? You don't want a gradual reduction in job openings. You got to get this stuff moving, man. Like we need some like we need a quick rug pull on jobs or something so we could get over this. Otherwise, we're just going to keep bleeding out in this market. It sucks. Participants expected the transition towards a softer labor market would be accompanied by an increase in the unemployment rate. Wow, this is actually the first time I've actually seen them say this here. But then again, we did see that on the summary of economic projections. They're projecting somewhere around a 4.1% on the last SEP. So let's see. A couple participants remarked that in light of challenges in hiring, businesses might be less willing to reduce their staffing levels in the event of a weakening in general economic activity. Why? Oh, because of difficulty hiring. So that's actually really interesting. They're making this argument here that some won't do layoffs, some businesses, because it was so hard to hire. I mean, that makes a lot of sense. You're kind of shell shocked. I mean, hiring sucks. Right now, we're looking for a CPA, or it doesn't necessarily have to be a CPA. Somebody to do accounting, sort of from the ground up. So we'll see. We're starting to look for folks who are course members right now. Participants observed that inflation remained unacceptably high and well above the committee's longer run goal of 2%. Okay, that's no news. Price pressures had remained elevated. Energy prices had declined in recent months, but remained considerably higher. Well, yeah, you could also blame OPEC. I mean, they're not helping us at all, cutting supply targets. Although realistic declines in actual output are probably going to be closer to 800K barrels. The 2 million barrel cut is it's a lot. Numerous contributing factors were cited as supporting this view. Labor market tightness. Okay, so far that's not news. With respect to the medium term, okay, let's see this. Let's see if we get any hint here on maybe when we're going to see some sort of peak. With respect to the medium term, participants judged that inflation pressures would gradually recede in coming years. Gosh, I mean, that's bad. Gradually recede in the coming years, right? Like, we want to see inflation plummet. Remember when so many folks were saying, hey, and I remember doing these analyses too. It's like, hey, like if inflation goes from $100 to $110, that's 10% inflation. For you to have another 10% inflation, you have to go to 121, right? But if we just stay at 110, you're at 0% inflation. And so we thought once we got through like one full year of inflation, the pain would go away. But that's not what you're seeing. You are actually seeing prices just continually go up. And so it's kind of a bummer that the Fed thinks it's going to be years basically to get inflation down. So I don't like that so much. What do we have here? Gradual easing of supply and demand imbalances in the labor and products market, and the likelihood that weaker consumer demand would result in the reduction of business profit margins from their current levels. Okay. Few participants reported that business contacts in certain retail sectors, such as used cars and apparel, were planning to cut prices in order to help reduce their inventories. I mean, to some degree, that's what the Fed wants, right? They want to see this go down. This is interesting. Let me see here. Reflecting. We're going to jump for a second here because this is a little bit of a red flag. Where is that? Liquidity conditions. Come on. Here we go. Okay. Let me just look at this for a moment. Development and financial markets. The manager pro term turned next to a discussion of policy implementation. Balance sheet runoff had continued to proceed smoothly over the intermeeting period, with caps on the redemption of Treasury securities and agency-backed mortgages doubling in September. The pace of balance sheet runoff was set to increase over the coming months. The market for Treasury securities and mortgage-backed securities continued to function orderly, though liquidity conditions in both markets remained low, reflecting elevated interest rate uncertainty. So that's actually not good. This is a little bit of a sign that you have really a market that's saying, hey, like, we don't want to put money in your bonds because we don't know how high these rates are going to go. Like, we'll just sit on cash, right? So this is a preference to cash, low liquidity. And then often, I hate to say it, but something something breaks when liquidity is low, right? So that's a little bit of a red flag. Let's just go ahead and write that down right there. I don't love that. All right, let's go back to where we were over here. Several participants commented that while households across the income distribution were burdened by elevated inflation, those at the lower end of the distribution were particularly harmed. In assessing inflation expectations, participants noted that longer-term expectations appeared relatively anchored, reflecting a broad range of surveys. Participants remarked that's because of basically them talking inflation down. Increased dispersion of long-term expectations across respondents in various surveys with an increase in the number of respondents, blah, 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 blah. So I actually personally believe that low inflation expectations actually potentially increase spending in the short term because people are like, inflation is just going to be transitory, right? Let's see here. What is this? Number of respondents. A few participants discussed the increased dispersion of longer-term inflation expectations across respondents in various surveys, with an increase reporting relatively low expectations as a key driver of the increased dispersion, but with a couple participants citing high inflation expectations among some survey respondents as a cause for concern and a reason not to be complacent. Okay, so in other words, expectations in the longer term are a little bit scattered, and so they're basically saying, hey, we can't pivot too soon. This is basically what they're saying here. Pivoting too soon is bad. So we have to make sure that inflation goes down. So, look at this. A number of participants. Look, what did I tell you was one of the worst things that could happen? And now here they are talking about it. That's not great. A number of participants commented that a wage price spiral had not yet developed. But cited its possible emergence as a risk. That's like terrible. Yes, Blau, kind of that liquidation evaporation is kind of like what's happening in the United Kingdom. Correct. This is a terrible line. That, like, I mean, it's one thing if Kevin's thinking about it. It's another thing if the Fed's starting to freak out about it. So that's not great at all. Is that all they're going to say about it? Really? That's all they're going to say about the wage price spiral? Jerks. All right. Let's see here. Let me actually just do a find on that word, spiral. Yep, one mention. Darn. Labor market was tight, blah, blah, blah. I've heard that like a million times now. But the fact that they mentioned the spiral, I wonder if they mentioned that in the last time they did this. I don't love that at all. And I think there would be a benefit to us looking at some of the recent, the previous releases. So the last one would have come out. Here we go. It would have been from the July meeting. I got it. Okay. And let's pop that PDF open. So these are the minutes for the July meeting. Let's see if they mention spiral in there. It's possible they just copy and pasted the same thing, right? And then it's less concerning. And I'm hoping it's less concerning. Okay, one mention of the word spiral. So this is the last one. Okay. In addition to the committee's ongoing policy firming and anchored long-term inflation expectations, these included competitive pressures restraining price increases and the apparent absence of the wage price spiral. Oh, that's bad. And then they're talking about commodities, right? So they briefly mentioned the spiral last time. That's a shift right there. That's not good. Because they literally went from the absence of a wage price spiral, this is terrible, to a number of participants cited it hasn't yet happened, but it could come. Oh, man, that's bad. That's not good at all. I don't like that little memo there because that's just going to indicate more tight Fed for longer. Now, I'm just taking a peek here at what some of Wall Street is saying. A couple of participants noted that businesses were constrained in new capital projects. Okay, let's take a look at that. But then they also have capital projects. The riskiest assets are attempting to rally. NASDAQ is up about 0.5%. Bitcoin back over 19.1. Interesting. Capital projects. Okay, we're going to take a look at that in just 1 second here. But I just want to quickly recap this because I probably think it's the most important. Last FOMC meeting, we had apparent absence of a wage price spiral. Today's minutes. So these are from August FOMC minutes. Let me just get the date really quick so we can, because this is August, but it's based on the July meeting, right? Yeah, July 26 to 27. I guess then this would be more appropriate to say July, but it's the August minutes. Well, the July meetings, whatever. July FOMC minutes, apparent absence of a wage price spiral. Today's minutes, we have, and when you contrast them like that, to me, it's just a little scary. We paged away from it. Here. Wage price spiral had not yet developed, but a number of participants cited its possible emergence as a risk. Yikes. Okay. Let's keep going. Sec. Okay. So then let's see here. Where were we with this business stuff? That was right here. With regard to the business sector, participants observed that growth in investment spending appeared modest. Participants mentioned that manufacturing activity had slowed. Interesting. I mean, this makes sense that manufacturing activity would slow because of, this inventory buildup that we've seen at a lot of companies, including Nike. Okay. A couple of participants noted that businesses were constrained in undertaking new capital projects as they faced higher financing costs. So that's actually the point of what the Fed is doing, right? Persistent challenges from supply chain bottlenecks and hiring difficulties because of continued tightness. So how many times have they so far said the labor market continues to be tight? It's almost in every paragraph. And it really, it makes sense now why we see this shift to a potential concern of a wage price spiral, because the labor market's just not getting any better. All right. So let's keep going here. Participants broadly judged the risk to real GDP growth to be weighted to the downside. Global headwinds included risk of recession in Europe, slowdown. Okay, so other things to know here is slowdown in Euro likely won't abate until at least early 2023, right? We need to get through this winter. I mean, even Paris is like turning off the lights to the Eiffel Tower to save energy. It's crazy. I'm going to put Paris. There we go. So then we have China with their COVID zero policy. That's probably unlikely to U-turn anytime soon. I don't think the party Congress is going to have any kind of change on their COVID zero policy. I don't think so at all. What's this one? So by the way, as I'm doing this, I'm also reading what Wall Street is saying. And so I like to jump around a little bit just to make sure I'm caught up with them while still reading. Participants observed that a period of real GDP growth below its trend rate, very likely accompanied by some softening in the labor market conditions, was required. I'm pretty sure that's to get, oh, look, we're right there. So we're pretty close to this. They also noted that inflation had not yet responded to policy tightening and that a significant reduction in inflation would likely lag that of aggregate demand. Oh, great. So they're actually telling you that inflation going down will lag demand falling. So in other words, AKA earnings will suck before inflation meaningfully goes down. Well, that sucks. None of this makes you want to own stocks right now. Participants observed that a period of real GDP growth below its trend rate, very likely accompanied by some sort of softening in the labor market, was required. They agreed that by moving its policy purposefully toward an appropriately restrictive stance, the committee could help ensure that elevated inflation did not become entrenched. These policy moves would therefore prevent far greater economic pain associated with entrenched inflation. Okay. In light of broad-based and unacceptably high level of inflation, intermeeting news of higher than expected inflation and upside risk to inflation outlook, participants remark, blah, blah, blah. Restrictive. This is why they're just explaining why they went to 75. That's fine. What about this 2%? Several participants observed that policy moved into the restrictive territory. Observed that as policy moved more into the restrictive territory, risks would become more two-sided, reflecting the downside risk that the cumulative restraint would exceed what was required. Okay, so you're finally starting to get some pushback, although you still had a unanimous vote for 75, right? So some pushback to tightening. But if fear of wage price spiral is more salient, then they will continue to hike. All right. I like, anytime I read PDFs, I like making little notes as I go through. Okay, so, I mean, that's basically what they're saying. It's like some people are like, hey, we got to be careful if we're tightening too much. But then again, if we're not worried about the wage price spiral, we kind of have to. Okay. In their discussions of monetary policy for the meeting, members agreed that recent indicators had pointed to modest growth in spending and production. Yeah, that's not going to be enough. Job gains had been robust in recent months. Unemployment rate had remained low. Members agreed that inflation remained elevated. Members observed that Russia's war against Ukraine was causing tremendous economic hardship. They also agreed that war was creating upward pressure on inflation. Okay, this is redundant, this part. Committee decided the target range. Okay, this is the 75 BP hike. Continue to monitor. Boring. Where was the part here that we were just talking about? Oh, no, never mind. We already jumped to that. That's fine. Continue to. Okay, now that we covered that. So far, the biggest concern I have is their concern about the wage price spiral. Let's do a quick little skim through some of the first pages here that we skipped initially. I don't know that there's okay, here. The exchange of the value of the dollar had appreciated notably, reaching multi-decade highs. Yeah, that's ridiculous. It's going to go down at some point, but apparently not anytime soon. Market implied path of the Fed funds rate shifted sharply higher. Well, that's what they want, particularly those provided at Jackson Hole. That's fine. Market implied path. Okay, well, we already know what the market's implying. That's not a big deal. They're just making that observation. I want to know what they think, not what the market thinks. I can see that separately. Reverse repos would decline in the coming quarter from its elevated levels as money market participants respond to shifting conditions. No. This is like, so far, RRR seems to be used more, not less. So the reverse repo facility is basically where banks can go park excess cash overnight. And I'm pretty sure those levels have been going up. Let me see. Reverse repo. Yeah, here we go. Stand by. Let's see what we got. Oh, yeah, come on, dude. That's not a decline at all. No way. It's like, it's been stable. It's been up and stable since June. I mean, if anything, I'd say that's a slight shift to the upside. We're now pretty typically at 2.2 to 2.3 trills. It's insane. That's insane. So that's not happening. Okay, Fed. Gradual reduction on reverse repo could be facilitated by rising competition among banks seeking deposits. Nope, not happening yet. Both of these developments would ease downward pressure on yields. I don't know. All right, talked about this. Credit remained widely available. Measures of current loan performance remained stable. However, more recently, expectations of future credit quality for businesses deteriorated slightly, and delinquency rates rose for some type of credit owned by households with low credit scores. I mean, that's why credit scores exist. They are a tool of determining risk. Broadening of inflationary pressures to core prices. That's not good. I mean, I know Wall Street is somewhat considering this report somewhat benign. I don't know, man. I'm not that happy about it. The shift there on the wage price spiral is probably the worst part. Bank of Japan. Okay, here, British pound dollar appreciating versus the British pound. Growth concerns weighed on foreign equity prices. That's fine. Outflows from funds dedicated to emerging markets continued at a moderate pace. Well, that's interesting. Emerging market funds are suffering outflows. Bank interest rates for commercial, industrial, commercial real estate increased. Anything on housing? Residential mortgages reached the highest level since 2008. Interest rates on most credit card accounts continue to move higher. Credit remained available. Boring. Credit availability for, let's see, volume of home purchase and refinance mortgage originations plunged in July. Well, yeah, that's no surprise. Mortgage delinquencies trended down in recent months. Yeah. By contrast, credit card and auto delinquencies rose in the second quarter, particularly among subprime. Well, yeah, also expected. The staff also pointed out the possibility that wage increases could put a greater than expected amount of upward. See, here you go. This is that wage price spiral again. Greater than anticipated or greater than expected upward pressure on inflation, and the possibility that inflation expectations could become unanchored given the large rise in inflation seen over the past year as additional upsides to inflation. So basically, they think as wages keep rising, inflation expectations could become unanchored. Yoinks. Unanchored. There you go. All right, next. Okay, we read through this. A couple participants remarked that after the process of the balance sheet reduction, it would be appropriate for the committee to consider the sale of mortgage-backed securities. So that lowers prices. So treasuries, just so you know, are usually rolled off. They just sort of expire. But MBS are usually sold. And those would be sold at a loss. Lower, more available equals lower MBS price equals higher MBS yields. So that would have the effect of potentially driving up mortgage rates. That's interesting. And that's also a red flag for real estate, because really they're saying here, hey, like, you know, we haven't yet started rolling off these mortgage-backed securities, but we expect that we will once they make suitable progress on the runoff. Okay. Don't unanchor. Okay. And that's it. Good. Let me see a little bit of what oh, I swear this person is copying my tweets, which is fine. It's an honor. But really? How long have I been talking about this? When did I send my tweet? I tweeted 12 minutes ago. 12 minutes ago, I tweeted about the wage price spiral. And this is when Wall Street picked it up. 1 minute ago. It's all right. We can all work together. It's fine. It's fine. Let's see what else they said. They didn't use the word recession for the United States. Any risks of a HELOC getting called? I don't think that HELOCs get called, but they can get frozen, so you can't borrow more. People trying to make the claim of evidence and a pivot in this. There is no pivot. There literally is no pivot. Where are people trying to claim there's a pivot? There's no pivot. Absolutely not. That doesn't even make sense. All right, let's do a summary. A short little summary here. And we'll get to the bottom of this. I also want to look at market quickly. Oh my gosh, Tesla's actually up. Oh, Carnival's up 10%. Get out of town, dude. They have so much debt. Roblox, 8%. You know, it's scary. There's some risky ones. There's a Firm, 3%. Zim. Oh, Zim went to $24. I shorted them at like $80. No, I shorted them at 86. I took a little profit and then I bailed. Oh, Voyager Digital is 6 cents. Oh, I haven't looked at these prices in a few days. Abe has a 1 in the front. I said it would happen, dude. Holy shices. Oh my gosh. It was over $8 when I sold it. I'm like, this sucker's going to $1. You know, I know the whole market moved down, but dude, that's a lot. Holy smokes. 166 and it was 8. The new number divided by the old number. Oh, that's about 80%. Holy smokes. Oh. Wow. Some nasty pricing. Twitter's still at $50 though. Apple 139. Wow, that's a good deal. Lulu, I think, has been holding up. How have they been doing? Yeah, I mean, obviously they've been having some level of suffering from euphoria as well, but they've actually been trending up here recently. They haven't been hitting new lows. How fascinating. Man, all those apes were hating on me too. All I wanted to do was warn that ticker symbol APE was a liquidity hell that you were walking into. And I got so much hate. Could have saved 80%. Hey, but at least now you can get 50% off on the courses on Building World. I'm sorry. I had to do it. All right, let's do a summary. All right. So, I don't really have a summary, but I'm going to do one anyway. Let's figure this out. How am I going to do this? I know what I'm going to do. I'm going to do what I do in pretty much every video. YOLO. Okay, hit the record button. I'll get the coffee mug. Hey everyone, me Kevin here. Oh boy, the Federal Reserve minutes are out. We just went through almost absolutely every single line in the report, and I don't understand. Apparently, some people are trying to allege the market's turning slightly green because the report wasn't as bad as it could have been, and that this report is somehow evidence of a Fed pivot. And I'm thinking to myself, what the hell are you smoking? This report actually had a very bad pivot to the bad side in it. And we need to talk about that pivot because it is the greatest risk to our economy. And this is not even just FUD. This is just like straight up potentially bad. We're going to talk about what that issue is. And they gave us a pivot to the dark side on that issue. So we have to pay specific attention to that issue. But what we're going to do is we're going to go through the report and I'm just going to show you the highlights. So let's do it. The first thing that we're noticing is liquidity is falling in the treasury market. So this is not great because this is the same sort of disaster that is happening in the United Kingdom. The United Kingdom does not have enough buyers of bonds. When you don't have enough buyers for bonds, price go down. And prices have been going down so freaking much in the United Kingdom for bonds that their Federal Reserve, known as the Bank of England, not to be confused with banks like in America, had to come in and set a floor. And that floor goes away Friday. They're like, yeah, we're removing the floor. So don't tell us we rug pulled you. So prices could then continue to fall. And they did so because pension funds were about to go bankrupt. And then millions of retired people in the United Kingdom would have been screwed without their pensions. It could have been a disaster. So anyway, the same kind of liquidity issues that we're seeing in the United Kingdom are now actually being remarked on by the Federal Reserve. That's not good. That is a lack of liquidity in the treasury markets because of elevated interest rate uncertainty. This is how things break. They talk about this potential that the reverse repo markets will get used less. That's not actually happening. So the reverse repo markets are when banks park excess cash overnight, and the use of those markets is exploding. We're like $2.3 billion. It's absolutely $1 trillion. I'm sorry. It's an insane number. I'll show you the chart right here. And so we're not actually seeing a decline here, which the Fed is hoping to see a decline here so they can actually see that their policies are starting to work, but they're not yet. It's still not working. So what the Fed's doing is still not really having an impact. Now, throughout this report, they must have mentioned about 20 different times that the labor market is still very, very tight and strong. And this is actually a really bad thing because at the same time as you have the labor market super tight, you have a broadening of inflationary pressures. Now, what's very important to remember about that specifically is that wages and inflation, hold on, let me find the section. Here it is. The Fed tells us that what's probably going to happen first is you're going to see demand fall and then inflation go down. But this creates a really kind of perverse trajectory. We'll follow along with this for a moment. The Fed says the Fed noted also that inflation had not yet responded to policy tightening and that a significant reduction in inflation would likely lag that of aggregate demand and that we'd probably need some softening in labor market conditions to actually get there. So think about what that means practically for a moment. That means in order to get inflation down, waiting doesn't work anymore. We actually have to see demand destruction. So demand has to go down, right? Big old down. Then after we see demand go down, we have to see that softness in labor. And only after that, and with a lag, do we actually get inflation down. So that kind of sucks because it tells us that, hey, look, we're going to probably have to suffer under the weight of high rates and bad earnings for longer because we have to get through the pain of bad earnings in order to have labor go down, which will then drive inflation down. So it's kind of just going to be a sucky process. In fact, in this report, the Fed talks about how it's probably going to take the, quote, coming years to actually get inflation down. I don't know how anybody read this and was optimistic about it. It wasn't actually good. In fact, we're starting to see, according to the Federal Reserve, credit card and auto credit delinquency rates rising over the second quarter. So in the third quarter, they rose over the second quarter. This, by the way, right here. So in addition to this little kind of path that I just drew for you, which is, let's go back to it for a moment. Demand has to go down. That hurts earnings. Then you see softness in labor. Then inflation goes down. That order is really terrible because in the meantime, if we get wages that continue to go up, so wages continue to go up, which encourages people to switch jobs, because if you switch jobs, you tend to get about twice the wage increase than if you stayed at your job. Quick explanation of that. That would mean if you made $100,000 a year, if you stayed at your job, maybe after 1 year, you'd be at about 107.4, which is about a 7.4% hike. But if you switch jobs, you might be at about 114.9, which is almost twice as much more additional pay if you just switch jobs, right? This is what the Fed is trying to prevent because it creates something really, really nasty known as a wage price spiral. Now, a wage price spiral is the absolute worst thing that could happen to the economy and could literally lead to an economic collapse. The dollar could collapse, the United States government collapse. And I'm not being overbearing here. Like literally, the Fed will do whatever they need to do to prevent a wage price spiral, and they won't let this really take hold because they know how bad it will be. Like you'll get Weimar Republic, you'll get Venezuela, you'll get all that if you get a wage price spiral. And so they have to kill this. Wage price spiral is where wages generally go up more than the rate of inflation. So let's say if wages are going up by 6% right now, and inflation is, let's just say 5.9%, in a few months it drops to 5.9, but now wages are higher, you technically have a spiral where wages are going up, then product costs go up because people have more money to pay for those things. So then you get product costs or people raise prices for products, then those wages aren't as valuable anymore. So people demand higher wages again to be able to afford those products. And you continue to get this stair climbing, which ends up looking kind of like a spiral. It's really, really bad. So what was really devastating was actually the difference. This is the pivot, okay? This was the pivot. The only pivot I saw from the Federal Reserve was the following, okay? It's on page 8 of the last last minutes from July. So from July 26th and 27th, on page 8, the Federal Reserve said the following. They said, in addition to the committee's ongoing policy firming and anchored longer-term inflation expectations, these included competitive pressures restraining prices, the apparent absence of a wage price spiral, the tightening of monetary policy, blah, 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 blah. Look at those words. This is the only time wage price spiral was mentioned in the last minutes. The apparent absence of a wage price spiral. That was last time. Look at what they said this time, folks. It's terrible. Okay, ready for this? It's right here. It's on page 6. The staff, is it here? Hold on. Maybe it's not actually on page 6. Hold on one second. Oh, sorry. It's also on page 8. It's right here. Ready for this? A number of participants commented that a wage price spiral had not yet developed, but cited its possible emergence as a risk. That's very different from the last report where they said no wage price spiral. Now they're like, oh, we might be at the start of a wage price spiral. That is how you collapse an economy. That is how you absolutely destroy an economy if you let a wage price spiral happen. This is terrible. Like, that's actually really, really bad. So they believe that the economy will be suffering from below trend growth in the coming years as they fight inflation down. They want to remind you to take advantage of the coupons on building your wealth for those programs before Friday at 11:59 p.m. because lifetime access will be getting stripped for anybody who buys, especially the Path to Wealth course after Friday at 11:59 p.m. So if you just want to guarantee you have lifetime access to the live streams and the courses, like new lectures that are added to the programs on building your wealth, just get in before Friday at 11:59 p.m. Then they also want to remind us that they're not seeing any kind of broad-based inflation yet. If anything, we're actually still, or deflation yet, I should say, we're actually still seeing some businesses that are like, oh, we're having some relief in supply bottlenecks. But then other businesses are like, no, we're actually not having any relief. So even though we're starting to see some commodity prices fall, not every business is actually benefiting from the commodity prices going down. Some businesses are like, what are you talking about? Like, inflation is still actually going up. So that's bad. We need like all businesses out there shouting like, oh my gosh, everything's getting a lot cheaper. We're not seeing that yet. At the same time, you're getting higher financing costs, which is slowing down investment, like fixed investment from businesses. And manufacturing is slowing down, which makes sense because inventory is piling up like crazy. Lower income individuals are getting screwed, but higher income individuals are still spending. They're actually holding up quite well. They don't believe the recession is real. So the Fed's like, all right, well, let's screw them. Let's start with their stocks, then we'll go on to their real estate, and then we'll just show up at their house and kill them. Okay, no, I'm just kidding. now I'm going to get banned off YouTube. That was a joke. Anyway, participants expected the transition towards a softer labor market would be accompanied by an increase in the unemployment rate. Last SEP, they estimated that the unemployment rate would go up to about 4.1%. It's kind of a nominal increase, honestly. They also talk about how some businesses won't actually lay people off because they're so jaded by how hard it's been to actually hire people. Weaker consumer demand would result in a reduction of business profit margins from their current levels. They're giving you an earnings warning right here. Businesses are planning to cut prices. They talk over here about how pivoting too soon is actually bad because, like, even though current shorter-term inflation expectations are anchored, longer-term inflation expectations are not, and they're actually pretty diverse. And so that's a risk that if you pivot too soon, you could end up destroying inflation expectations. Then inflation starts going back up, and then you're really screwed. So whoever's saying the Fed is indicating a pivot here is just smoke and crack. In my opinion, the slowdown in Europe, this is the only time they mentioned the word recession was actually about Europe. Recession in Europe right here. I don't think the slowdown in Europe is going to be over until at least 2023. Probably, I mean, like, their winter is going to suck. I mean, Paris is already turning off lights to like the Eiffel Tower and stuff to save energy. This could hurt real estate rates more, the sale of mortgage-backed securities. Keep in mind that treasuries are rolled off, mortgage-backed securities are sold. So rolling off just means they're not buying them again, right? Because they're shorter term. Mortgage-backed securities are like 30-year bonds. They're likely going to get sold at a loss. More of them being available lowers the price of those mortgage-backed securities, which are a type of bond, which leads to higher yields on mortgage-backed securities, potentially driving up mortgage rates. Bad for real estate prices. Good for HouseHack. Which, remember, if you're an accredited investor, go check out househack.com and get yourself founder shares. No upfront dilution. You are buying shares at the same price I'm buying them for. $1 equals $1. We're basically selling shares of the company at net asset value is what we're doing. Some people are like, well, just call it that. And we're like, okay, yeah, I mean, that's a fair way to put it. But anyway, this isn't a solicitation. Get all the details on the PPM over there at househack.com. Okay, so we talked about the trajectory of inflation going down. There was some pushback that, we have to be careful that, and this is potentially where some people are getting this idea of like a pivot from, that they have to start considering the downside risks of tightening too much. But keep this in mind, the wage price spiral is worse and more important than that consideration, in my opinion. And so I think even though this will be a concern, it doesn't imply a pivot at all. And that's it. So there you have it. That is a summary of the Federal Reserve's minutes. Thank you so much for watching. Make sure to subscribe for more of this content. And remember that tomorrow at 5:30 a.m., the CPI report will be coming out. Delta Airlines also reports tomorrow, says Blau. That'll be really interesting. The summer travel season, I think, was very great. American Airlines already preliminarily guided higher on both revenue and margin, but still like down 9% from 2019. Yeah, Fed already said the risks of doing too little outweigh the risks of doing too much. Exactly. New supply squeeze on gasoline from OPEC feels like they just want the world to burn. Well, I mean, you have to remember these oil companies, they really got screwed during the pandemic, and they shut a lot of wells, and they fired and laid off a lot of people. Now, like, you look at oil kind of like this. Okay, watch this. Wells, not Wells Fargo, okay? Oil wells went from like that to like that because of COVID. And it's come back really slowly. The reason for that is a lot of these companies have had to take on a lot of debt just to stay alive during this period of time. And it's also hard to hire like new oil workers, right? Deck workers, engineers, whatever. So I'm not here to sympathize with the oil companies, okay? I'm just saying, like, they're going to do whatever they can to milk high energy prices as freaking long as possible. And they're going to use that to pay down their debt and hopefully continue to open more wells. But anyway, that's just my thesis on oil. So, like, from a capitalistic point of view, I don't think you can argue that the oil companies are wrong to cut supply. I think from a social point of view, they're total jerks. But not from a capitalist point of view, it makes sense. Capitalism isn't nice. Okay, CPI tomorrow. Thanks so much for being here. We'll see you soon. Goodbye.